Good morning. Welcome to our webinar, Thinking of Life Beyond Your Business. Do you fully understand your exit options? This webinar will last about 40 minutes or so, the content, and then there's opportunities to ask questions at the end. But please ask the questions as we go along using the Q&A facility at the top or bottom of your screen. And we'll pick up as many of those questions as possible when we get to the question stage at the end of the webinar. What we're covering this morning is a very brief introduction to who we are, why we're qualified to talk about exit options and the different exit routes. And then my colleague Greg Barker will talk about exit options, trade sale v management buyout, which are the two main exit routes for most people, how we can help. And then, as I say, we'll answer questions at the end. So please do use the Q&A button to type in your question as we go along, and we'll pick up as many of those as possible at the end. Just a bit about us. We are corporate finance advisors. We work full-time in working with clients who are selling their businesses or buying a business. We believe in giving quite a lot of early stage advice so that clients embark on the right route and understand where it's going to lead, what sort of values are involved before they start. So we get asked several times a month to do valuations. Often that work gets referred by accountants. Do valuations as to what a business will be worth in the real market rather than some hypothetical valuation for maybe for tax purposes. We give quite a lot of exit option advice, so advising on where trade sales likely to lead, is there appetite for their type of business in the market, what sort of value they're going to achieve. Similarly, management buyout advice, what sort of deal can be achieved, what sort of value, how much could be paid up front, how much would be on deferred terms, what sort of funding appetite there is for that business, and structuring MBOs, negotiating deals. Quite a lot of early stage advice. So when a client embarks on a trade sale or a management buyout, they know where it's going to lead, what the value is likely to be, what the terms of the deal are likely to be, so they can be satisfy themselves before embarking on a transaction that they're going down the right path. And we get involved in fundraising, and a big part of it is project management. Once the transaction starts, project managing it from start to the end. Both Greg and myself have been a strategic corporate finance for many, many years, advised on numerous transactions, and the next slide shows a selection of those transactions. First of all, looking at trade sales, corporate acquisitions and trade sales, corporate sales. The same photos appear on the website and are clickable. So if any of those stand out, you want to know more about that transaction, click on the same photo on our website. It'll tell you all about it. So that's trade sales. We've got a similar number of management buyouts, occasionally management buy-ins. And again, the photos on the website, click on them if one of them stands out. But really, the point these photos are making is that our experience is around 50-50 between corporate transactions, which are trade sales, and management transactions, management buyouts. And therefore, we understand both options and we're well placed to advise on the different options. I'm going to hand over to Greg at this stage for the rest of the webinar, and I'll join again at the question section at the end. But please do, if you've got questions, use the Q&A facility to ask your question as we go along, and we'll answer those at the end. Thank you.
Thanks for that introduction, Andrew. Morning, everybody. As Andrew's mentioned at the top, I'm going to be giving a brief overview of the different exit options available to business owners before looking in a bit more detail at the two most common forms of exit, being a trade sale and a management buyout. So this slide lists 6 different exit options, as well as trade sale and management buyouts. I'm going to look at institutional buyouts, management buy-ins, employee buyouts, and the final point on there is the final option on there is a simple winding up process. I'm not going to dwell on that, as that's usually very much a last resort as an exit option for business owners. But it can be appropriate in some limited circumstances, maybe if there's a very high value balance sheet containing a high value of land and buildings, and cash. And maybe that's just become out of kilter to the size of the business, in which case, a liquidation and winding up might be the best option. But I'll talk more about the other 5 options over the next few slides. So the first sort of option, and is probably the most common, is a trade sale, being a sale of your business to another company, usually in the same sector. It could be a competitor, or it could be another trading business that operates in an adjacent sector or market. One of the big attractions with a trade sale as a form of exit is typically it would offer a clean break for the owners of a business. Usually we find that clients look at exiting their business when they're coming up to retirement, and therefore there's usually a preference to have a clean break and then sort of move on to retirement or whatever else the individual wants to do with their time. That's not always the case, though. In some businesses, the owners can be very sort of important to the day-to-day operations of a business, and there may be a need for them to stay with the business in a management capacity for a longer length of time than just a short handover period. And in some situations, that might not be what a short handover might not be what the owner wants. They might want to continue working in the business once it's sold. So every situation is different. One of the features with selling a business to another company is that usually there will be changes made within the business after it's sold. Those could be fairly minor, just in terms of how the management structure is set up and some of the reporting processes. Or they could be very major. It could be that at the extreme, the business is broken up and relocated, and it's really the latter, those sorts of changes to a business, that can be a concern to business owners, as very often, yes, they do want to exit and they want to realise full value for the business that they've grown over the years, but at the same time, they want to preserve their legacy and want to sell a business with confidence that it's still going to be around in the same form and still successful years into the future. So another sort of key attraction with a trade sale is that very often most, if not all, of the consideration for a business would be received in cash at completion. There might be a small amount held over for 12 months or 2 years, just in case that the buyer needs to make any claims against the former owners, so that there's some money sort of set aside for that purpose. It might be that you might have an earn-out on top of the amount that's paid at completion if there's some growth targets set for the business that form part of the deal. But generally speaking, most of the cash paid for the shares would be paid over on day one when the deal completes, and that's often a key objective of business owners when they're considering an exit. Finally, on that slide, it's important to note that with a trade sale, the process can be sort of long and winding at times, especially if it's a business that is at a smaller business, or one that where there are certain risks that would be difficult for a trade buyer to get comfortable with. So maybe it's a business where it's because it's small in size, it's reliant on 1 or 2 key individuals for running it, or 1 or 2 key customers. And in those sorts of situations, it can be difficult to find a buyer who's willing to sort of pay, make an offer that's attractive to the owners. A trade sale process, even if it's very swift, can take sort of 6-7 months from start to finish. There'll almost always be a high level of due diligence involved. So yeah, it's it can be a challenging process to go through. So we'll contrast that against other forms of exit as we go along. The second exit option is the management buyouts, probably again along with the trade sale, a very common form of exit. So rather than selling to a third party, another company, this is a sale to the management within the business. It can offer an opportunity for a clean break for the owners, like a trade sale, but it really depends on the business and the specific circumstances. If it's a business where it's very common for SME businesses for the owners to be quite heavily involved in day-to-day operations, and that may mean that the second tier management team that need to sort of develop their roles in order to take over everything that the business owners do. That might be something that can happen very quickly. It might be more of a process where the former owners gradually step back from the various roles that they perform and hand over more responsibilities to the second tier management team. But that again, that can be an attractive feature for owners in that they might not want that clean break straight away. They might be very happy to remain involved in the business for an extended period of time, perhaps move into a non-executive chairman type role for a number of years, and act as a mentor to the management team after the MBO has taken place. In contrast with a trade sale, a management buyout is an internal transaction, and therefore there's no sort of immediate need for the business to change how it operates. Essentially, it'll be business as usual. The management team will still run the business. There'll be no sort of changes to what happens within the business. So from the perspective of the company's employees or its customers or suppliers, nothing's changing, and again that can be an attractive feature for business owners in considering how they exit. The biggest sort of constraint with the management buyouts is funding. So compared to a trade sale where a buyer may be well funded and able to pay the consideration in cash in full at completion, with a management buyout, you are restricted to how much cash can be raised on day one by borrowing money. So how much money can be borrowed depends on the type of business and its cash flows and profitability and what assets are on the balance sheet to use as security. But very rarely you'll be able to raise more than sort of half of the deal value through raising debt, and that means there's usually a substantial amount of deferred consideration involved in management buyout structures where there are future payments made to the exiting shareholders over a number of years. So that's a disadvantage of management buyouts, but it does mean that there's an opportunity for the current owners to reinvest part for perhaps a minority stake in the business as part of a management buyout, and also get a return on that money that they've left in the business. So that could be through charging interest on the deferred consideration at a market rate. So very different from a trade sale, and again I'll move on to sort of contrasting that with a trade sale later on in this presentation. The third option is similar to a trade sale and a management buyout in a way, and that's a sale to an institutional investor. And that could be usually is a private equity firm, or it could be a family office set up by a high net worth individual. So with a sale to an institution, there's an option, again, depending on the type of business, there's an opportunity for the owners of a company, if they are heavily involved in running it day to day, to de-risk, so to sell perhaps a majority share in the company, but then keep a minority shareholding and continue to manage the business day to day on behalf of the private equity owners. This could be an attractive option for younger owners of companies where they have grown the value of a business to a certain level and want to realize part of that capital growth, but they're not, not looking to retire and are happy working the business. And there's an opportunity to continue growing the business alongside private equity owners. If for older company owners perhaps who are looking to retire and there is a management team in place in the business, again, an institutional buyout can offer that opportunity for a clean break, just like a trade sale. With a sale to an institutional buyer, the business does need to have solid growth potential, and that sort of growth potential would need to be detailed in a clear business plan that would be provided to private equity investors. Most private equity investors look for the same kind of things in their target companies. So they'll want to see a strong market position, good barriers to entry, a strong management team, good sort of track record of profitability over a number of years. Low commercial risks. So again, the things like undue reliance on a small number of customers, that would be a difficult risk for a private equity investor to get comfortable with. The process involved with an institutional buyout is very similar to looking for a trade buyer. There would be a period of several months whilst the business is prepared for sale. The marketing documentation would be prepared. Possible private equity investors would be contacted. There would be a series of meetings with potential investors, offers received, probably very extensive due diligence, perhaps even more due diligence than you would find with a sale to a trade buyer. But with a trade buyer, it's typical that they would be operating in the same sector, so they already have an understanding of the market, and they would probably have a clear idea as to what the risks are and how they would go about dealing with those risks. With a sale to a private equity investor, they probably wouldn't have that degree of industry knowledge, and also they are ultimately professional investors and have to be very rigid in terms of their process, and therefore the amount of due diligence that would be conducted would be quite high indeed. The next option, similar to a management buyout, is a management buy-in. The difference here is that rather than selling to an existing incumbent management team, you would be selling to an incoming management team who don't have any knowledge of the business already. So this is similar to a management buyout. It's probably seen in companies where that are perhaps subscale, so don't have that sort of quality management team in place already, and they therefore need to look outside the business for managers to come in and take over. It can provide a clean break for exiting shareholders, but again, depends on the circumstances. But usually it's because the owners want to retire and leave. With the management buy-in, like a buyout, although it's kind of business as usual within the business, having an incoming management team can provide impetus for business to kick on and grow. And I've seen this with management buy-ins I've been involved with in the past, where perfectly naturally, if you've got a business owner that's coming up to retirement and is comfortable with how the level they've grown a business to, growth might not, is probably not going to be their priority. Where and selling the business to an incoming manager with their own ideas. They're going to be very, very sort of highly motivated to grow the business and make changes that will enable the business to sort of reach the next level. So that this can be a very successful exit option for some businesses, perhaps those where a trade sale is difficult, or a management buyout is difficult. The same sort of funding constraints apply as a management buyout would. Unfortunately, it's rare that incoming managers have a lot of money to invest in these deals, and therefore they're going to be reliant on how much money can be raised by the company and the willingness of the exiting shareholders to agree to a deal structure that involves a significant amount of deferred consideration. The final option I'll just touch on is the employee buyouts. So this is something that's become more popular in recent years, mainly due to changes in tax legislation. So this would involve typically an employee ownership trust being set up, which would acquire the shares of a company at market value. The key sort of tax benefits for exiting shareholders is that by meeting provided certain conditions are met, they can avoid paying any capital gains tax on the proceeds that they receive from selling their shares. And this might become more important, perhaps, depending on what happens to capital gains tax over the next 12 months or so, as we are anticipating changes to capital gains tax. Just like a management buyout, it's an internal transaction, and therefore nothing's going to change straight away. Business as usual. So it can be an attractive option from the point of view of the owners wanting to leave a legacy and ensure that the business it isn't broken up or absorbed into another business after it's been sold. Another sort of key attraction with an employee buyout is that it can be quite a simple sort of deal process, in that there would be a need to involve third-party experts to determine what the market value of the company is, but then there wouldn't be any sort of further negotiation around the price with the employee ownership trust. That's the price that the shares would be acquired for. There can be very, very little due diligence involved. It really depends on how much funding is sought from banks as part of any funding structure. Like a management buyout, very unlikely that most of the cash would be received for your shares on day one. A very significant part of the consideration would be paid on deferred terms over a number of years. But with an employee buyout, probably the key drawback is that it doesn't sort of address management succession at the same time as ownership succession. So with a management buyout, responsibility for leading the business really sort of transfers across to the management team on day one. With an employee buyout, the shares of the company are held by a trust for the benefits of all employees, and therefore the buck really sort of rests still with the former owners, really, in terms of their sort of financial risk. So they may need to remain involved in running the business on a day-to-day basis after the point they've completed an employee buyout, and there may need to be a period of several years while the management team are strengthened to the points where the former owners feel comfortable to take more of a step back before ultimately retiring. So that's a very quick sort of overview of the different options available to business owners. I'm now going to focus a bit more on the two commonest sort of options, being the trade sale and the management buyout, and sort of look at some of the key differences between the two. So I'll look at what might be different in terms of the valuation applied to a business, the process that's involved with those two options, how they differ in terms of business continuity and the involvement of the owners going forward, how they're funded, and also just quickly touch on the confidentiality aspects. So just looking at valuations, first of all, there is a sort of a general perception out there that a trade sale will deliver a higher valuation for a business than an internal transaction like a management buyout. And the thinking behind that is that trade buyers have more money. They can often benefit from synergies and cost savings, and therefore a business might be worth more to them than it would be to the managers in a management buyout situation. So sometimes that's true. If particularly if there's competition amongst many trade buyers for a business, and there's a bidding situation, or there's a circumstance where a trade buyer has a very sort of clear strategy of consolidating a market and paying above market rates for businesses in order to sort of consolidate and grow. You might find that they're willing and able to pay a premium over and above market value for acquisitions that they make. In reality, however, it's much more common that trade buyers want to pay as little as possible for acquisitions they make, and that's because they are in a position of power. They can sort of pick and choose which acquisitions they want to make, and it comes down to risk, really, in that if a trade buyer is making an acquisition, all of the risk associated with that business transfers to the trade buyer. And therefore, they've got to sort of price in that risk to the deal structure. They'll also commonly take the view that any cost savings that they can generate ought to belong to them, rather than factoring it into their valuation and paying that extra value over to the exiting shareholders of a business. So if you contrast that with the management buyouts, they can often be able to pay a price that's higher than what might be achieved through selling a business to trade, and that comes down to how the risk is sort of allocated with a management buyout, how the deal's funded, and the perception of the risk. So just to explain those points, with a sale to trade, all the risk associated with the business, the risk of key customers disappearing or key managers leaving the business, all that risk transfers to the trade buyer on day one. With a management buyout, the same is the case. However, because of the way management buyouts are funded, managers are only investing a relatively small amount of the overall finance that's needed for management buyouts. The vast majority of the funding is provided by the company itself and the exiting owners through providing deferred consideration as part of the funding structure. So the financial risk really rests with funders providing debt finance and the exiting shareholders who are providing vendor finance, deferred consideration. So the managers, yes, they will be risking some of their own money, which will be an important amount to them, but ultimately most of the risk lies with other parties in the transaction, so they can afford to push that price up a bit higher. Also, their perception of risk will very often be different. So if it's a business where again there are sort of a few key customers that are critical to the business, the management team will have those relationships with those customers. and therefore their perception of that risk is going to be very different to a trade buyer, where they don't know those customers, they don't understand why that those customers wouldn't leave the business, and therefore their perception of their perception of risk will have an impact on their perception of value. The process involved with a trade sale compared to a management buyout is very different. So with the trade sale, there would be a long process to go through of getting the business ready for sale, marketing, meeting with potential buyers, receiving offers, negotiating those, due diligence, legal stage. A lot of that can be shortened with a management buyout, because the parties to the deal are known to each other right at the outset, so there's no sort of marketing process involved. With a management buyout, it's possible to take advice on what the valuation should be, how the deal should be structured, how it could be funded right at the outset, and then if the shareholders are happy with that basic deal, that can be presented to the management team, and usually it's a straightforward decision for them to agree to that proposal. So you can sort of reach a sort of a heads of terms position with a management buyout very quickly compared to a trade sale, unless of course you've had an offer from a trade buyer come out of the blue without a marketing process, in which case that could obviously shortcut things. So with the trade sale, the process is quite long. It's also quite uncertain. You never quite know what offers you're going to get, and how many potential buyers will be interested. So you can sort of deal with that risk to an extent by taking early advice and considering if there are any issues within your business that would make it difficult for trade buyers, and obviously get a professional valuation for your business, so that you can have some comfort over what sort of the level offers might be pitched at. But ultimately, it is an unknown. You don't know what offers you're going to get until you get well down the line, and it's a possibility that no offers are forthcoming that meets your expectations. Negotiations with a management buyout tend to be a lot easier. Not always. I mean, it depends on the relationships between the owners of a business and the managers. Usually, I find that those relationships are very good, and that's part of the reason why a management buyout is being considered. But sometimes there is tension between managers and owners, which can make things more difficult. Compare that to a trade sale. Obviously, you're building a relationship from scratch with a trade buyer, and for the reasons talked about price, they're likely to negotiate very hard. Whereas with a management buyout, you can more or less set the terms of the deal, and the power rests with the owners. The management team aren't really in a position to start negotiating on the price. Due diligence is also a key difference when it comes to the process. With a sale to trade, the buyer has no knowledge of the business, and therefore they will conduct extensive financial due diligence and legal due diligence. The management team themselves wouldn't need to kind of conduct that due diligence, because they would already know about the business. They might need to do some limited legal due diligence to look at areas that they aren't familiar with, for instance, maybe the tax affairs of the company. But generally speaking, there's very little due diligence that would be needed by the management team. The funders backing the management team might, however, need some due diligence performing, particularly if they're obtaining a term loan from a bank to help fund a management buyout. Then there would need to be some financial due diligence undertaken. But generally speaking, the due diligence is easier with a management buyout. Moving on to continuity, I've touched on this a couple of times already while I've been talking, but with a management buyout, it is a case of business as usual. The management team, yes, they can provide some more impetus into the company and new ideas, and perhaps looking to grow the business faster. But ultimately, the business is going to be the same as it was before it's been sold. There is a risk with a trade sale that major changes take place within the business, and that can be an issue. With a management buyout, that's generally seen as a sort of a less sort of it can be presented as a very positive sort of thing for the company. A company's staff aren't daft. They might sort of see that the owners are getting older and may start sort of thinking about what happens next once the owners come to retire. If there's an announcement there's a management buyout has taken place, usually that's a big relief to a company's employees that that sort of risk has been taken away. They know who's taking over in terms of the management team, and there's not going to be any sort of major disruption to the business. Contrast that with an announcement that a trade sale has taken place. That can be more of a concern to staff and perhaps to customers as well. So yeah, with a trade buyer, it's likely that they'll be making at least minor changes to the company's organizational structure and how it operates going forward. A trade buyer could be a good thing, however, if a business does need to kind of become part of a larger organization in order to actually sort of help it grow. This is something that happens quite a lot, in that a business can suddenly expand very rapidly by becoming part of a larger group, because the new owner can open doors, cross-sell to other customers within its organization, and allow the company's staff to take on more responsibility and perhaps grow their role beyond the business they work in, and take up more of a group role within their organization. Funding is a key difference between these two exit options. With a trade sale, the buyer will be responsible for funding the deal, and if they're a large company with cash reserves, that can be a big advantage in that there's no fundraising process needed. That's not always the case, however. Sometimes you might have a deal where you're selling to a trade buyer that hasn't got the cash to hand, and does need to raise money from a bank, or perhaps even negotiate some deferred consideration with the owners of a business. But generally speaking, funding is easier with a trade sale. It's the main constraints with putting together management buyouts, because the managers themselves are unlikely to have much money to introduce, and therefore how much money can be raised depends on what can be raised from a bank, or possibly private equity as well. So whilst that's a kind of a disadvantage for exiting shareholders, it can present an opportunity at the same time. So because there might need to be a large element of deferred consideration within the deal structure, it means that again, more power rests with the exiting shareholders in terms of setting the price of the deal and the terms. So it could be that to compensate the exiting shareholders for having to wait several years for all of their money, it might be appropriate to retain a minority shareholding in the business that would provide capital growth over that time period, and enable a further sale in the future. So increasing the overall deal value. And also there's an opportunity to charge interest on the deferred consideration, which maybe something that's is attractive to business owners, because they're suddenly going to have a lot of cash on hand from selling their business. They'll need to reinvest that money somewhere. Why not reinvest it back into the business where you can make a very good return, and you understand the business, and therefore ought to be comfortable with the risks involved. So confidentiality, predictably, this is much easier to control with an internal transaction with a management buyout. Everything's in-house, so you're only talking to the management team members and the company's funders and advisors. Therefore, the risk of gossip spreading is quite limited. But even if it does if word does get out that a management buyout is being contemplated within the company, it's not going to set any alarm bells off amongst staff or customers or suppliers. Contrast that with a trade sale. There is a need to go out into the market and look for potential buyers, and therefore there's a risk of people not honouring confidentiality agreements and gossip spreading within an industry. So that can be more of a problem in some industries than others. But yeah, it's something to bear in mind. With a trade sale, you will need to, as you sort of go through the process, share more and more confidential information with potential buyers. At the outset, it can be anonymized, but then once confidentiality agreements are put in place, you will need to let potential buyers know the name of your company, what it does, etc. And as you once you've reached a deal in principle with a buyer and then moved into due diligence, there'll be another level of information that you'll need to disclose. And at some point in that process, it'll probably be necessary to provide names of customers, names of suppliers, which is usually manageable, but in some instances that can be quite a risky thing to do, and in some instances buyers may need to speak to key customers ahead of completing a deal, and usually if that's the case, that would happen at the very last minute in a process, perhaps the week before a deal completes. But yeah, it's important to just bear in mind the implications of looking at a trade sale compared to a management buyout when it comes to sharing information. So just to wrap up on that then, so what are the situations that are best suited to a trade sale? Typically it will be situations where the owners want to have a clean break. A management buyout would need to probably they would probably need to remain some involvement for several years, even if it's just until they've received all of their deferred consideration. A trade sale much more likely to be able to have the whole process completed within a short period of time. A trade sale might also be a better option if the management team don't have any sort of ambitions towards taking over the business. And also where there's a high degree of deal activity within a sector, and you can be confident that you will find trade buyers interested in your business, then this can be a good option. The final point on this slide, a business does need to have manageable commercial risks when it comes to a trade sale. If it's a business where ideally you want to be selling a business that's got a sort of a clear track record of consistent profitability over a number of years, giving a buyer confidence that trend will continue going forward. If it's a business that's very lumpy, it's based on winning a small number of large contracts, and there's a lot of volatility in its trading results, that can be a difficult business to sell, as would a business that's unduly reliant on its owners for management or a small number of key customers. And situations best suited to a management buyout, perhaps situations where the buyer doesn't need to sort of make a clean exit and want to remain involved after the sales completed, perhaps in a chairperson role. Where there's an enthusiastic management team that the owner wants to back. And I've worked with clients in the past where they for this reason they felt that a management buyout was the best thing to do. That perhaps they themselves took over ownership of the business through a management buyout, and therefore want to give the next generation of management that the same opportunities that they had. Situations where the owners don't need to sort of raise all of the cash on day one and are prepared to part fund a deal. And finally, again, where there's commercial risks that would put off trade buyers, perhaps undue reliance on the management team, that risk wouldn't apply to a management buyout. So just to conclude, it's never too early to start thinking about what your exit might look like and to start planning for it. We're very happy to sort of speak to business owners wherever they are in their sort of business life cycle to talk around what options are available. Every company is different. Every company owner has slightly different objectives, so it's sometimes it's not clear what the best option is straight away, and it really depends on the sort of specific circumstances. Quite often there's too much focus on the sort of headline value for a deal, but other aspects are equally important, such as how the deal is funded and structured, whether the money's paid out on day one or whether it's on an earn-out, what the implications are for the company and its staff and its customers. So all the tax implications of a deal, all of those different kinds of things need to be sort of considered at the same time, not just what the deal value is. Don't automatically assume that a trade sale will give the best results. Sometimes management buyouts can provide a higher valuation. Finally, take early advice, speak to professionals with experience, don't leave your exit planning until too late. So how can we help? As I mentioned, we're very happy to have initial meetings with business owners at any stage to have a conversation around their company, their aims and objectives, and see give our initial views and see if we may be able to help. In terms of specific pieces of work that we can perform as part of to help inform business owners with their exit option planning, we regularly provide valuations for clients, because that's really underpins everything. If the valuation isn't high enough, then that may mean that owners need to spend more time in the business to grow it and grow the profits to get the valuation to a point that they need it to be before initiating a sale or a management buyout. Critically, it's really key to kind of have a solid understanding of your business's value before you set out on a sale process, and not to leave anything to chance or face the possibility of having an unsuccessful trade sale process where your desired price isn't met. Building on that valuation work, we can also provide our views on what the most appropriate exit options might be, what they would look like for a particular business, and as part of that, look at how a management buyout could be structured, whether it's feasible, how much funding could be obtained from different sources, how much deferred consideration would be needed, what the managers would need to contribute themselves personally. So that early stage advice is often extremely well received by clients and enables them to make an informed decision on what the best course of action is, and potentially avoid costly mistakes by not sort of doing that early stage assessment. So once the early stage advice has been conducted, if our clients wish to then move forward with a deal process, be that a trade sale or a management buyout, we can provide lead deal advisory services from start to finish. So with a trade sale, this would involve preparing the business for sale, preparing the marketing documents that are needed, researching potential buyers in the UK and overseas, confidentially marketing businesses for sale, inviting offers, negotiating bids with potential buyers, drafting heads of terms, and taking the deal from heads of terms right through to legal completion, working closely with our clients, other professional advisors, solicitors and accountants throughout. And critically, dealing with the inevitable issues that get thrown up in any process. They're never straightforward. There's always problems that need to be solved, and we see our role as having oversight over the whole process, and having that sort of bank of experience behind us allow us to see problems perhaps before they arise, and come up with solutions, and make sure that deals happen on time and smoothly. So that concludes our presentation. Have we got any questions through, Andrew?
It's got a couple of questions so far, but it's not too late. If you want to ask a question, please use the Q&A facility. Just type in your question. We'll try and pick it up in the next minute or two. So the two questions we've got so far, Greg, are, is now a good time to sell? Shall I have a go at answering that?
Yes, please do.
I think it's quite a wide question. I think it covers really four different parts. So is now a good time to sell? We're certainly, in terms of appetite, if it's a trade sale, are the buyers out there? We're seeing plenty of appetite at the moment, and we have done for the last. It paused for 3-4 months during COVID, but picked up very, very quickly, and there's been good appetite ever since for the last 2 years or so. I think the second aspect to this is probably funding. If you're doing a management buyout or you need to fund a trade acquisition, is the funding out there? And again, there's good funding appetite. We'd obviously have to look at your individual circumstances and advise you in individual circumstances, but we find there's plenty of funders, plenty of independent funders out there funding deals. Tax is always a key issue when you're thinking about, is now a good time to sell? We're expecting possibly a change of government in the near future, and tax regimes could change at that point, or could even change tomorrow, couldn't they, in the autumn statement? We've seen tax on owners of businesses increase over the last few years. When entrepreneurs relief was there, which is now called business asset disposal relief, an individual would get up to £10 million at 10%. That's dropped now to, under business asset disposal relief, to £1 million limit at 10%. And it's possible that could get eroded even further, particularly if there's a change of government, because the government has obviously spent a lot of money on COVID and other issues, and subsidising electricity and gas bills over recent years, and needs to start thinking about taxes. So tax regime's pretty generous at the moment. If your gain is only £1 million and you qualify for business asset disposal relief, you'll pay 10%. But the most important aspect in answering, is it a good time to sell your business, is how your individual business is performing. So in terms of the business performance, the risks in the business, and some of the issues that Greg has already talked about, it tends to be individual factors that are the most important. But if you're looking to sell soon, yes, there's plenty of appetite, there's plenty of funding. The tax regime is still reasonably kind and is highly unlikely to get better, the tax paid on exiting. So yeah, for most businesses, now is a good time to sell, but it depends on your particular business. We've got 3 more questions, Greg. The second one, probably a very quick one, so I'll answer it very quickly. If bought out completely, can you still be employed by the company without losing business asset disposal relief? Yes, is our understanding. Yes, you can. Obviously, check with your own tax advisors. That is very common where somebody sells and continues to be employed. You can protect your business asset disposal relief by retaining a qualifying shareholding as well, which is something that Greg's talked about. If you are selling to a management team and there's quite a lot of deferred consideration, to reinvest on the same terms as managers, which means investing quite a small amount for a new uh, shareholding in the new holding company, can protect your business asset disposal relief going forwards as well. So it's one to take advice on, but if bought out completely, can you still be employed without losing business asset disposal relief? Yes, that's our understanding, but obviously check it out. The next question, Greg, is management buyout v employee buyout. What's the difference, please? And is there a tax
Yeah.
difference?
Yes, so management buyout, either the management team would directly buy the shares in a company, so that could be one manager or several managers, but they would end up being the majority shareholders of a company. With an employee buyout, it is the wider sort of employees of a business that take ownership. That can be direct ownership, where each employee has a certain number of shares in the company, or much more commonly, that's an indirect ownership model, where there is a trust established that owns all of the shares in a company and holds those shares for the benefits of the employees together collectively. So the indirect model is far more common at the moment, and there's a crucial difference in terms of tax, in that a majority sale to an employee ownership trust means that there is a 0% tax rate on for capital gains tax for exiting shareholders. With the management buyouts, it's the usual sort of capital gains tax rate, either 10% if it qualifies for business asset disposal relief, or 20% otherwise, that would be paid on the gain from a sale to a management buyout. With a sale to an employee ownership trust, subject to certain conditions being met, the tax rate would be zero.
Thanks, Greg. And that actually answers the fourth question as well, which was about the capital tax rate applying to an employee ownership trust. You've just clarified that is zero. So that's it. We've got no more questions. Thank you. Thank you for listening this morning. We have recorded this webinar. So if you've missed part of it, or you want to watch it, or have a colleague who wants to watch it, we'll email the link to you either later today or tomorrow, to where we have saved it to YouTube. So you're welcome to watch it again. Please do get in touch. We'll welcome the opportunity to talk to you individually about your own businesses. And in sending out the link to the webinar, we'll send an invitation that, do you want to have an individual chat? Because we've talked in general terms here, but nothing beats having an introductory chat, which we usually do by Teams or Zoom in the first instance, unless you're very local. To talk about your business and how we might be able to help. And obviously that's at a no cost, no obligation basis. Thank you for listening. I'll finish the webinar at this stage. Thank you.